Deckers Outdoor Corp, ticker DEC, is currently trading at $102.54, up $1.54, which is a 1.52% move for the day. Now, the common expectation when people hear the name Deckers is, frankly, UGG boots. They picture a one-trick pony, a fashion brand that had its moment in the 2000s and should have faded. The reality, however, is that Deckers has engineered one of the most stunning brand transformations on the market, turning itself from a fashion cyclical into a high-performance growth machine. The public perception is stuck on UGG, but the financial reality is all about HOKA. This massive disconnect between what people think Deckers is and what the numbers prove it has become is the entire story, and it's why this stock has been a favorite for institutional funds and a puzzle for retail investors. Looking at the recent trading action, this 1.52% gain is happening in what's been a very nervous consumer discretionary space. Investors are obsessively watching inflation data and retail sales figures, trying to guess if the consumer is finally cracking. When you see Tesla stock gyrate based on delivery numbers or Apple stock move on iPhone demand in China, it's all part of the same question: will people keep paying premium prices? Deckers is right in the middle of that debate. The expectation is that $170 boots and $150 running shoes are the first things to get cut from a family budget. But the reality, as seen in their recent earnings, is that both UGG and HOKA have demonstrated shocking pricing power. Today's steady upward move suggests the market is betting that Deckers' brand strength is durable, not fragile. We're seeing solid volume, but nothing erratic, which implies this isn't just retail traders on their Robinhood app chasing a headline. This is more likely calculated positioning from larger portfolios, the kind managed through Fidelity Wealth Management or traded on sophisticated platforms like Interactive Brokers, which are acknowledging the company's operational excellence. That operational excellence is the real story, and it's critical to understand what Deckers actually is. The company is a brand portfolio manager, and a brilliant one at that. UGG is the legacy brand, the cash cow. The expectation was that UGG would die. The reality is that management smartly repositioned it from a fad to a comfort staple, expanding into slippers, apparel, and menswear. It's now a resilient, high-margin profit engine, especially in the holiday quarter. But the growth engine, the reason this stock has outperformed so many others, is HOKA. Deckers acquired this niche maximalist running shoe brand years ago, and it has exploded. HOKA is now a legitimate powerhouse in the serious running community, stealing shelf space from giants like Nike and Brooks. Its growth has been in the double digits quarter after quarter. This two-pronged attack is the core of the business. UGG provides the stable profits, and HOKA provides the explosive growth. They also own Teva and Sanuk, but HOKA and UGG are the two pillars that matter. The most recent earnings report from yesterday, October 23, 2025, perfectly illustrates this. The company reported Q2 fiscal 2026 results that beat analyst expectations on both revenue and earnings per share. Revenue hit $1.43 billion, a 9.1% increase year over year. EPS came in at $1.82, a 14% jump from the prior year. This is the kind of performance that tech stocks like Nvidia stock are praised for, yet here it is from a shoe company. The driver? Both brands are firing. HOKA sales grew 11.1% to $634 million. UGG sales grew 10.1% to nearly $760 million. Think about that. The dying brand grew at 10%. The international segment was a huge story, with sales rocketing up 29.3%. This is a company that is successfully expanding its global footprint. However, there was a catch, and it's why the stock has seen some turbulence despite the beat. The company's direct-to-consumer sales actually decreased by 0.8%, while wholesale, selling to other retailers, grew 13.4%. This is a slight reversal of the high-margin DTC narrative, and the market is watching it closely. Furthermore, their full-year sales guidance of $5.35 billion was a bit shy of the $5.57 billion analysts were hoping for. This is the classic beat and lower scenario that frustrates investors. This creates the central tension for anyone looking to invest online in Deckers. The company is executing brilliantly, with gross margins holding strong at 56.2%. They have over $1.4 billion in cash and no debt. They are actively buying back their own stock, $282 million worth in the last quarter, a massive vote of confidence from management. This is the kind of rock-solid fundamental data that long-term investors using Fidelity brokerage services or Schwab Intelligent Portfolios dream of. It's a quality company, but it's priced for growth. Any sign of that growth slowing, like the slightly soft guidance or the dip in DTC, makes the market nervous. This is where the self-investing crowd on SoFi Invest might get shaken out, while institutional holders on Interactive Brokers might be looking at the 13% drop yesterday as a buying opportunity, which could be feeding into today's 1.5% rebound. Looking to the future, the bull and bear cases are crystal clear. The bear case, the expectation, is that the party has to end. HOKA's meteoric rise will slow as competition from On Running, Nike, and others intensify. They'll argue that UGG's 10% growth is a temporary blip, not a new normal, and that a recession will eventually crush demand for premium footwear. They'll point to the 52-week high of over $223 and say the stock has a long way to fall if growth even hiccups. The bull case, the reality for believers, is that HOKA is just getting started. Its international penetration is still low, and its brand awareness is still climbing. They see it becoming a true lifestyle brand, much like Apple stock transcended computing. They see UGG as a resilient, multi-generational brand that has proven its pricing power. The bulls will look at the massive $2.2 billion remaining on the stock buyback authorization and see a huge safety net under the share price. They'll look at the P/E ratio, which at around 15.7 is trading near historical lows and looks cheap for a company posting double-digit earnings growth. They'll argue that the dip in DTC was temporary and that the international growth story is the main event. For them, this isn't just a shoe stock, it's a brand management powerhouse. This brings us to the most important question for any consumer stock. I want you to comment below with your thoughts on this. Are you seeing more HOKA shoes or UGG products in your daily life than you did 2 years ago? Let me know what you're observing on the ground. So, as we watch Deckers trade here at $102.54, we're looking at a company at a crossroads. The expectation is that it's a cyclical shoe company that had a great run. The reality is that it's a highly profitable, debt-free, brand-building machine that has consistently proven skeptics wrong. The tension is between its impressive, durable performance and the market's fear that this performance is unsustainable. The latest earnings report gave ammunition to both sides, a strong beat on profits, but a cautious word on future sales. This stock is a case study in brand power versus macroeconomic fear. The company has shown it can navigate the storm, but the market is now demanding nothing less than perfection. Warning: this content is for educational and entertainment purposes only. It's not financial or investment advice. Always do your own research or talk to a licensed financial advisor before investing. Markets move, risks are real. Trade smart. Like, comment, and share if you found this helpful. HOKA stock, investing, finance.